Hello everybody and welcome to this new video which is about the health disruption. My third pillar. It's my third pillar of investing. I have three main buckets of investing. Really quick, if you're new to the channel, you know I've covered MicroStrategy a lot lately. I covered a lot of Bitcoin proxies. But in my view, it's all about alpha. It's all about generating higher returns. And I see three main buckets that are worthy of picking stocks in. Three main buckets that are going to generate a tremendous amount of alpha in the coming years. And so the first one, of course, the revolution of finance as a whole, digital finance as a whole, Web3, all that sort of stuff, but Bitcoin is the biggest play in there for me in the form of MSTR over Bitcoin treasury companies. I also like Hood a lot, I like Coinbase, but that's the revolution of finance. That's bucket number one. Bucket number two is intelligence, the revolution of intelligence. Tesla is my biggest play here. And why is it my biggest play? Well, there's self-driving, right? That's launching. That's the biggest real-world AI project out there, but there's also embodied AI. Embodied AI is, of course, the Optimus bot that is about to be launched maybe 2 years from now. I'm also big on NVIDIA, SMCI, Nebius. At some point, quantum will probably belong there and will be the revolution of intelligence, but I think quantum is too early. And then the third bucket, which is the bucket I'm going to talk about today, is the revolution of health. Health is the third and only final sector which, in my view, right now can rival the revolution of finance and can rival the revolution of intelligence as a major bucket of investing. And in health, as my third bucket, of course, HIMS is my big play, but I love all sorts of health tech and health disruptors in this space. There's another bucket to give you a sense of how I think. I think there will be another bucket in there, which will be space at some point added, right? I think there will be 4 buckets at some point, and space will be part of that bucket. But I do think we are way too early for this to be a bucket of its own. So for now, I'm putting it aside. For now, I'm looking at 3 buckets: digital finance, intelligence, digital intelligence, and of course, health, digital health, you could say too, and talk about this general trend of health. So let's talk about the health techs, the health plays. 2 stocks I talk about way too much on this channel, along with MicroStrategy, is HIMS and a little bit LifeMD. I talk about LifeMD, of course, way less than HIMS. But you know that HIMS is a channel darling, channel favorite. It's up today. I don't know. HIMS like to be trading around $50 these days. So it's the price, the market is still wrapping its head around. This stock is stuck into the modern day era, the modern world of digital doctors, digital pharmacies, without insurance, but with clear pricing, with customization, with net promoter scores in mind, making sure that you actually deliver an healthcare experience that's like 5-star out of 5-star, where if you look at the average rating, people are extremely satisfied with the experience they get with HIMS, which is not something you would get from a local clinic. So HIMS is kind of, some people say, the Netflix of healthcare. I think LifeMD is a little closer to the Netflix of healthcare because they have their $19 a month subscription for doctor access. But HIMS is kind of kind of a high net promoter score type company. In many ways, they're closer to the Amazon of healthcare, if you ask me, where they take a lot of verticals and they disrupt these verticals by product, right? They disrupt it by product. So what HIMS does is they go after a very profitable segment of healthcare, one that is historically has been the cash cow of your mom and pop clinic, and they take that sector, they digitalize it, they train doctors, and then they prescribe that one drug in that category, and then you end up that in the real world, the medical office buildings, the health system, they're just left with a very complicated cases, and then HIMS kind of gets all of the cases that are easy, and these cases, of course, are addressed. These patients are helped without insurance, and not having insurance, in my view, is the chief reason, the main reason why HIMS is able to move so fast, and it is even the reason why HIMS is able to move faster than LifeMD. Because if there is one thing that I don't like about LifeMD is how they try to use insurance benefits, and they've spent a lot of time, CEO talks about this, CEO of LifeMD, they've spent a lot of time building the back end to try to get people to qualify for XYZ benefit. All of that time at LifeMD spent developing the back end, trying to communicate with insurance. At HIMS, they've spent that time, they spent that executive attention on growing very fast, on marketing and growing very, very fast. They have, and I think they will continue to grow very fast. HIMS, as I noted in many prior videos, their revenue has clearly accelerated the past 3 quarters. It's rare that you see a company who's been growing very fast who actually has revenue growth accelerating and not decelerating. Usually it's an asymptotic curve, right? Usually revenue kind of, you move from 50 to 45% revenue growth to 40% revenue growth to 35 to 32 to 30. Like usually you have this asymptote, right? You don't have that with HIMS. HIMS revenue has shot up, which I was totally not expecting, and a lot of people are very happy about that. But revenue growth is accelerating for a company which is now not a small cap anymore. $11 billion, that's not a small cap anymore. That company is getting noticed. Which stock do I like the most between baby HIMS, i.e. LifeMD, and HIMS right now? Well, I dare to say I like HIMS a little more right now. I think LifeMD LifeMD needs to take a breather, and I know there's a lot of shorts, and it's a stock that was shorted heavily. So I think over a short term it could take a breather. But as you may know, I'm not a short-term person. I look at the long term. I think at the long term, today we have physical clinics and health systems everywhere. I think in the long term, there's going to be a few apps. And HIMS, I'm pretty darn sure HIMS is going to be one of the big winners, one of the big apps. Maybe Amazon is going to have a big app. Maybe LifeMD is going to have a big app. LifeMD is doing really well. LifeMD also owns RexMD, which is a direct competitor to HIMS. Maybe they will too, but they're still a small cap, very riskier, smaller position for me. HIMS now, to me, I consider this a medium cap, and it's my 3rd largest position. HIMS is my 3rd largest position. So whenever HIMS move, it shows in the portfolio. So HIMS is moving today, so I'm pretty happy about that. But anyways, moving on to other stocks. Now talking about a stock that I don't own, which is Oscar. As you know, on this channel, I hate the insurance space. I absolutely hate it. It's the business of denying claims. I know it's a gross oversimplification, but when I look at their first quarter results and I look at that, it's medical loss ratio, and they brag that their medical loss ratio is lower than the rest of the industry. So it's all about collecting in more premiums than you pay out, and so built in you have. I just don't like the insurance business. Like built in, you have incentives that are not really aligned. That means the more premiums go up, you need the premiums to go up. So you need the cost of healthcare to go up, right? If you're gonna have revenue growth, you probably hope that the cost of healthcare goes up. It creates a very perverse incentive. But, and this is what I'll say, but when I see a stock under a 0.02 enterprise value over gross profit over revenue growth. As you know, this is my metric for growthy value stocks. For growth and value combined, a growth value stock combined, my metric is enterprise value over gross profit over revenue growth. As a reminder, why do I use that metrics, right? Why do I use gross profits? Because, GAAP thinks that say investment in marketing or investment in R&D is a one-time expense. But in the 21st century, that's not true. In the 21st century, investment in marketing can yield results over a very, very long run. So I look at that as an investment, not really as an expense. Revenue growth, I think, is the most important factor. Revenue growth doesn't lie. For this company, revenue growth is not very good. It's a 24. I mean, it's good, but it's not HIMS, right? But it's still pretty good. Probably the lowest you'll see out of all the companies I cover today. But what is dirt cheap, of course, is this enterprise value. It's over GP over RG. It's a 0.0119. I mean, this is ridiculous. Look at even the more accepted metrics. So this is a stock whose enterprise value is 910 million, and they have 10 billion of revenue. So forward revenue, right? Enterprise value over forward revenue is 0.07. Okay, that's in the insurance business, of course, but it's still ridiculously cheap. And enterprise value over adjusted EBITDA is a 2.5. It's so cheap. This stock is so cheap. The EBITDA is not very good right now. EBITDA margin at 2%, but that should increase, right? You should have some operating leverage as the revenue grows. So if I buy this stock, it's because it's so cheap. It's gotten way cheaper lately. It's gotten way cheaper. And of course, I think a main reason why this stock is cheap is the sector. They deal with the ACA, understand Obamacare is what they deal with, and they provide insurance plans to Obamacare recipients, and so it's a very government-driven world, a very government-driven institution. Something, once again, which I really don't like because it can really hurt your growth. But nonetheless, a stock that is too cheap to ignore, perhaps. And I've covered it briefly in a video about 2 months ago. The stock got cheaper since I covered it briefly about 2 months ago. 2 months ago, I didn't buy. We'll see how cheap the stock gets. I might be interested in buying as much as I dislike the sector. Sometimes the valuation is too cheap to ignore. Anyways, moving on to now biotechs, moving on to health and biotechs, moving on to the supplier of health, right? The actual makers of the drugs, the actual makers of the systems, right? The start of the value chain. If you look at the health value chain, you have the delivery of health. That's your doctor on HIMS. You have your insurance. That's the delivery side. This it's the side of delivery. This is the entrance of the delivery. This is who does the therapy. I ramble here. Let me move on. TGTX. So let's talk about the first stock. TGTX. So TGTX is a full position for me. I'm done building that position. TGTX. They own BRIUMVI. BRIUMVI is a CD20 therapy, so modern biotech technique for treating multiple sclerosis. Multiple sclerosis is a very painful disease. It's not like patients don't have a choice to not treat it. They have to treat it. And there's only 3 therapies approved, and there's only 3 therapies that will only ever be approved. And so this means that BRIUMVI, along with the 2 competitors, is likely going to be a cash cow until 2042. That's why I say this biotech space, is definitely a favorite. I love it very much. I find a lot of companies with a lot of growth, but it's plagued with rent seeking, and it's also plagued with single decision makers that can hurt your business. In the case of a company like BRIUMVI, it could have been the FDA. Now they are done with that. They're approved, but you'll see with BioStem, you can have a single decision maker at the CMS who can pretty much make your business thrive or die. And it's really, really riskier. These stocks are riskier. Anyways, TGTX, they own BRIUMVI, like I said. It's the last FDA approved therapy. They're going to be a cash cow until 2042. And the product is priced more cheaply than the 2 competitors, and it works faster because it is the latest drug. The drawback to that is that it's less known than the leading CD20 therapy for MS, which is called Ocrevus, which is well known by providers and treatment providers. And so they have a sales team, and it's all about making it better known that the product is cheaper and is faster. And of course, the bigger argument for selling these products is very often the fact that it is faster, not necessarily the fact that it is cheaper because of the perverse incentive of the reimbursement system, where actually if you reimburse a product that is a little more expensive, it's going to help you with your insurance rates next year because you're showing the cost of healthcare going up. Anyways, very, very weird incentives. Lots of potential headwinds, and you understand why I love HIMS. HIMS is able to grow so fast because HIMS doesn't have to deal with the issues that happen oftentimes at the beginning of the health value chain. But the growth can be outstanding, and the profits can be astounding. So let's talk about BioStem. BioStem is another product that is ripe with risk, and it was a riskier stock when I started covering it. It was actually even cheaper than this. It's still very, very cheap. BioStem is still the cheapest stock in the history of the channel, 0.008 on enterprise value over gross profit or revenue growth. The cheapest in the history of the channel, never been a stock this cheap. I've never seen a stock this cheap. Their product is now on the Medicare list until January 2026. At the turn of 2025, a lot of people were fearful that the product would not be on the list anymore. It is still on the list. It is still making a bunch of money, which means that they have, over 6 months left to make a bunch of money, and then you have risk again. But the valuation is ridiculously cheap. You're talking about a product that has a gross margin of 97%, and it's trading at an enterprise value over forward revenue of a 0.32. So, the company's enterprise value is 180 million. The revenue is 302 million. It's growing at 80% and 97% gross margin. And then they invest a lot in the business, and they're working on making this product qualify for diabetic foot ulcers, which could be a huge market for them. They're working with an uplisting on the NASDAQ. That could also be a big boost to the share price, to the stock price. But again, this overhang, we're living large right now. Life is good because we don't have the overhang coming up, but we need to realize that the overhang is going to come back up in 2026. The LCD needs to still include Vendarhe, the product, right? If you look at this Zacks small cap research, which is the best article I can find about this, besides my own research, is they talk about the fact that BioStem isn't the only company who believes the LCD was arbitrary and capricious, and that other companies who will turn to the legal system to overturn the LCD released earlier this week. That was about 6 months ago, and then they delayed it again, and now it's a 2026 thing. But every time the LCD updates, which is the Medicare reimbursement schedule, if you're not on the list, it oftentimes means your business is going to be in deep trouble, because most people will take the product who is reimbursed by Medicare. Most people will choose a product based on reimbursement, not based on medical advantages, unless you're cash pay or something like that. So because most people will take the Medicare payment, and the other annoying thing is that all of the insurance companies follow what the CMS has to say. So if it's not on the CMS, it's a much bigger deal than not getting Medicare. It's a bigger deal because you don't get any insurance oftentimes because they copy Medicare. So anyways, I didn't even tell you about the product. If you want to know about the product is a wound care bandage that is made out of placentas that are donated, so they get the product for free. So it's 97% gross margin, and it's the better way to say it is a human connective tissue matrix composed of amniotic tissue. That's the better way to say it. But it's a bandage made out of placenta. It's really interesting in my view. It changes a lot of the I'm going to call it a pig. The pig-based bandages oftentimes is made out of a pig skin. It disrupts that, and a lot of people don't want to use these xenografts. And oftentimes in the medical field, they'll use a acronym so that you don't know exactly what the product is. They'll use an acronym because xenograft sounds so much better than swine or something like that. Anyways, let me move on. Cormetics. Let's talk about Cormetics. So Cormedix is a stock that I own. Oh, by the way, I didn't tell you. I own BioStem. I own TGTX. Cormedix is a stock that I own as well. It's definitely a great stock in my view. Why do I say that? Well, this was a Patreon exclusive, but I released it 4 days ago. But it was a Patreon exclusive. The reason why I love Cormetics, of course, it always starts with valuation with me, right? It's like, because there's a lot of great stocks in the medical field, but you got to pick them based on the valuation. Valuation is a 0.06. Rule of 40 is a 240. This one is extremely profitable. Gross margin is also very high. Revenue growth is very high. What do? They deal with dialysis. So at dialysis center, Davita Healthcare, Fresnicius or something like that. When you have kidney failure, patients need to receive dialysis, and they typically receive it for say about a year or something like that. And the problem, of course, when you get on dialysis is infections. You can get infected, and these infections cost a fortune to Medicare. And so Medicare has a very strong incentive and actually bases reimbursement of dialysis center based on how few infections they get. And from what I understand and can read, Medicare was very quick to approve and reimburse this product, which is the first FDA-approved antimicrobial catheter lock solution with heparin and taurolidine. So what is a catheter lock solution? So a catheter is placed, right? So you have these tubes coming out of your chest, and once you're done with dialysis, you go home, and oftentimes you can get an infection in there if there's no fluid. So by putting this fluid in there, you reduce your odds of infection dramatically. And because of that, well, you live longer, but you also don't get an infection that can cost tens and tens of thousands of dollars because you need to go to the emergency room, and then Medicare has to pay. And so it's a product that's highly ethical because you're avoiding the infection, and it saves a lot of money. And in the grand scheme of Medicare, it's a cheap product. It's $200 and change a vial. One vial is $200. So in the grand scheme of things for Medicare, it's also a cheap product because that can save you tens of thousands of dollars, and you got to use it each time, of course. But they're in this context, they're really trying to avoid the infection, because these infections can actually cost hundreds of thousands of dollars depending on the severity. It's rare, but they can cost 70, 80 grand. You know, it's sometimes less, sometimes more. But you got to see the incentive. I see the incentive in this. So I don't think there's going to be a risk of non-reimbursement for this one, which means that the adoption and the growth is very, very high in this company. I like Cormetics a lot. I think it could be a 10-bagger, and that's why I own it. The last one, which is a new stock for me, I covered it. I did a deep dive on the Patreon. I will probably release it on the main channel at some point within the coming weeks. We'll see. We'll see, depending on my schedule. But this is Delcath or Delcath. Sorry, Delcath is these names look alike. This one is called Delcath. So Delcath is, per my understanding, and if you're on the Patreon, feel free to go look at this video I made about it. Per my understanding, it is a tiny bit. It's I'm being facetious here. It's a big revolution in the way liver cancer is treated. A cancer historically where there is not a lot of treatment options. This one seems to be a bit of a breakthrough. And it seems to be a bit of a breakthrough. I'm reading stuff about hospitals rushing to adopt it, cancer centers rushing to adopt it, and the revenue growth is predicted to be around 50%, gross margin 86%, EBITDA margin, they're already there. Think about that. When those products work, you can make a lot of money really quick. 36% EBITDA margin. Gross enterprise value over gross profit over revenue growth is 0.07. And the treatment appears to be very, very popular. And again, dollars don't lie. Dollars coming in via the top line, they don't lie. And so this is a stock that I don't own yet. I'm looking to own it. I will update on the Patreon as soon as I buy it. I haven't found, there's still a lot of opportunities right now. So I haven't found an opportunity to focus on that part of the portfolio, but I will. So anyways, this is another interesting one. So a bit of a different video today, a lot of stuff, a lot of content. I hope you were entertained. This was not investment advice, not financial advice, not health advice, not insurance advice, not financial advice. This is only entertainment. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.